Hi, this is Wen, and it's almost Q4. As we, a tax practitioner, says, if you want to change your tax, you need to change your fact. If you want to change your fact, you need to make it happen before the year end. So let's look at the 5 most asked tax questions and some tips I want to give to you. Alright, the first most asked question about tax is, when is the tax deadline? Alright, that's simple. April 15, everybody knows. And if you need a little bit more time to collect data, documents, or just get everything ready, you can file an extension and get 6 months extra time. But remember, the 6 month extra time is given to you to finish paperwork, not given to you to delay the payment. So in case you need an extension, remember to attach an estimated payment. That way you can avoid any penalties. Alright, next question. Next frequently asked question is about student loan interest deduction. Yes, the 2,500 student loan deduction still apply, but there has a few but. The first one is if your filing status is married but filing separately, that deduction doesn't apply to you. Second things, when your income goes higher and higher, this deduction might phase out. For example, for a single tax filer, if your income is more than 75,000, it's starting to phasing out, which means the deduction would decrease. And when your income, modified gross income, reach 90,000, and it's gone. Alright, and also a little detail is if you receive more than 600 interest, please remember to ask for 1098E, and that way you can get things ready. Alright, and the third thing, retirement contribution. So hopefully everybody knows retirement account has many tax benefits. And the number one is it defer your taxable income. So the money you contribute to your retirement account, you don't need to pay tax the current year. It was taxable when you're taking the money out of your retirement plan. So it's a good idea to maximize that contribution. And there's a few numbers, just quickly go through. If you have 401k, it's 22,500. If you have traditional IRA, it's 6,500. And if you are a business owner or your own boss, you might have more complex, I would say, retirement plan like simple or SAP. Each plan has their own rules. Just ask questions and do it with the tax professionals and figure out that magic number that works for you the best. Alright, next topic, charitable contribution. We often see the advertisement say, we are a non-profit organization, please donate to us, and your donation is tax deductible. It might and might not. It depends on, do you itemize your deduction? So everyone gets standard deduction. You don't need to do anything. It's automatic. For some people, they choose to itemize their deduction, which means they add all the items under that itemized deduction together. For example, charitable contribution, your mortgage interest, the property tax, the income tax you paid, and add everything together, and you figure out a bigger number. If it's an itemized deduction, you go with the itemized deduction. If it's a standard deduction, you go with standard deduction. So charitable contribution only matters when your itemized deduction is bigger than your standard deduction. And here's a very good tool I often suggest to my clients. It's called Donor Advised Fund. So for example, you donate every year to see San Francisco Ballet $2,000 because you just want to support art. and that $2,000 you can count as your charitable deduction for the current year. But if you do one thing slightly different, you put 5 years amount of donation, $10,000, into your donor advised fund. That $10,000 can count for your current year charitable deduction. And for SF Ballet, nothing like really different for them. You can still give order to your donor advised fund, says okay, send 2,000 every year. So in that case, you kind of put together your 5-year worth of charitable dollar into 1 year's of deduction. And I think this is very powerful tool if you use this well, and also it's good for the society. All right. Little things about contribution is it's a trend IRS is looking more carefully about this item. So if you have charitable contribution, remember to document, especially if you have a big amount of donation. All right. This question, a little surprise for me because it's kind of like default things you would think first, but actually if you don't work on the tax field, it might be things worth some effort. So filing status, if you are single and you don't have any dependent, then you just file as a single. But when the life situation changes, you might have different option to file tax. For example, if you have a child but you're still single and you support the majority of the children's spending, and then you might qualify as a head of household. As you can see here, the deduction for head of household is way higher than the single person. So that's a difference. And if you're married, you can file your tax together with your spouse as a married filing jointly, or you can file it separately. Purely from tax perspective, filing jointly is a better tax treatment, because many deductions, credits doesn't apply if you marry filing separately. So that's that part. Okay, the last but not least, tax gain and tax loss harvesting. So income tax based on your income. If your income number changes, your tax will change. Some income you cannot change it. Whatever amount you got paid from your employer, it's your income. But some income, it's controlled by you. For example, the investment income. I mean the stock you own, the mutual fund, ETF you own. When you sell it, make a difference. All right. So here's a chart which put the tax rate of ordinary income and long-term capital gain income on the same chart. It's very straightforward. You can tell the long-term capital gain tax rate is lower than the ordinary income tax rate. So if you can hold your stock more than 1 year and 1 day, it's become a long-term capital gain. And other scenario, if you already at a very high tax bracket, and I would suggest you avoid or postpone your gain. You have a really good stock, and don't sell it when your income is at the year your income is very high. Or if you say, okay, I must sell it because if I don't sell it, it will change. So if you already realize a big investment gain, consider at your portfolio, if you have some loser, consider at the same year sell those losers. So a winner give you gain and loser give you some loss, and you can mutual your income, taxable income. You may say, oh no, it's not a loser for me, it's just undervalued right now. So in that case, you can buy them back after a month. You can sell your loser but buy a similar company at the same time. So that way you can also create that loss, which we usually call tax loss harvesting. The third thing is if say you take a year off from your work and the current year your ordinary income is very low, and then at that year you might considering sell your winners to realize the gains. The reason is when your income low, your long-term capital gain tax rate is also very low. It's 0 under certain threshold. So, timing is everything. All right, that's for today. Thank you.